Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai Fosun Pharmaceutical Group, Co. Limited, Annual Report. Shanghai Fosun Pharmaceutical Group, Co. Limited, offers a diverse range of businesses and services across various segments. The company's pharmaceutical manufacturing capabilities cover multiple therapeutic areas, including solid oncology, immune-inflammatory disorders, metabolism, and more. In addition to its pharmaceutical business, Shanghai Fosun also provides medical devices and equipment, such as mRNA vaccines, medical aesthetic devices, mechanical ventilation devices, high-end surgical robots, and medical consumables. The company's diagnostic solutions include biochemical, immune, molecular, microbiological, pathological, and chronic care management services. Furthermore, Shanghai Fosun offers healthcare services, including specialized medical treatment, online and offline medical services, insurance services, and the operation of hospitals. The company also engages in the distribution and retail of healthcare products through its various business units. In summary, Shanghai Fosun Pharmaceutical Group, Co. Limited, S businesses and services include pharmaceutical manufacturing, medical devices and equipment, diagnostic solutions, healthcare services, hospital operations, and healthcare product distribution and retail. Shanghai Fosun Pharmaceutical Group, Co. Limited, market capitalization of $74 billion, is significantly larger than the average industry peer of roughly $2 billion. This shows that Shanghai Fosun Pharmaceutical Group, Co. Limited, holds a significant advantage in their industry. Shanghai Fosun Pharmaceutical Group, Co. Limited, trades at a higher price-to-earnings ratio of 14 times and a lower price-to-book ratio of 0.95 times relative within the industry. This suggests a potential market detachment, as Shanghai Fosun Pharmaceutical Group, Co. Limited, trades at discounted levels while the broader industry remains fairly valued, warranting deeper fundamental analysis. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the revenue growth side, innovative drugs have been a significant contributor, with a year-on-year increase of 29.59%. This is attributed to various factors such as upfront payments, potential sales-based milestones, and license-out agreements. The global penetration of core products has also played a crucial role in driving revenue growth. The approval of serplulimab injection in over 40 countries and breakthrough therapy designation in Saudi Arabia have accelerated deepening in emerging markets. Additionally, the launch of innovative products, expansion into new markets, strengthening commercialization capabilities, and digitalization have all contributed to revenue growth. On the other hand, revenue decline can be attributed to various factors, such as a year-on-year decrease in segment results for the healthcare services segment, a 3.84% decline in pharmaceutical manufacturing, and a 1.98 percentage point decline in major products of tumor and immune modulation. Net income experienced a mixed trend in the given period. Initially, it saw an increase of 21.3%, rising from RMB 2,770 million to RMB 3,371 million. However, this growth was short-lived, as net income subsequently decreased by RMB 99 million year-over-year due to high fixed costs in the rehabilitation specialty chain business. Furthermore, a significant decline of RMB 60 billion was observed. The profit margins also underwent changes during this period. The gross margin witnessed an increase of 4.11 percentage points, rising from 47.77% to 51.88%. This improvement can be attributed to the company's focus on core operations and enhanced medical disciplines. Additionally, the net profit margin saw a rise of 1.65 percentage points, increasing from 8.59% to 10.24%. The gross profit margin less selling and distribution expenses ratio also experienced an increase of 1.18 percentage points, reaching 27.73%. The company's financial performance indicates a positive trend in its operating cash flow. According to reliable sources, the net cash flow generated from operating activities has been consistently reported as RMB 5,213 million for both 2024 and 2025. This information is corroborated by multiple pages within the document, providing strong evidence of the company's ability to generate positive operating cash flow. As a result, it can be confidently concluded that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. While the total debt level has decreased by approximately RMB 1.528 billion, or a reduction of about 6.8%, from RMB 22.62 billion to RMB 21.092 billion, there are contrasting trends in other areas. Specifically, interest-bearing bank and other borrowings have increased by plus 14.6%. Furthermore, despite the decrease in total debt level, interest expenses have also seen a notable reduction, decreasing from RMB 1,431,915 in 2024 to RMB 1,265,351 in 2025, indicating a significant decrease of about 11.7% in interest expenses. The company's performance across various segments and regions has been mixed. On the positive side, medical manufacturing saw a significant increase in revenue of $29.7 million, while other healthcare distribution business also experienced growth of $7.3 million. The pharmaceutical manufacturing and distribution segment reported RMB 3.3 billion in results, with healthcare service and other business operations also showing modest gains. Innovative drugs was a standout performer, with revenue increasing by 29.59% year-over-year, while overseas business saw a 14.87% growth. Certain product lines such as Peijin, Akinzeo, and Yikaido experienced over 30% revenue growth, and Han Likang, Hankyu, and Han Sizhuang maintained steady growth. However, some segments struggled to keep pace with the company's overall performance. Pharmaceutical diagnosis service reported a significant loss of RMB 58,496, while other retail operations incurred a loss of RMB 31,907. Medical devices and diagnosis segment also saw a decline in results, as did health retail operations, which reported a loss of RMB 13,745. Management is emphasizing the importance of innovation and expansion in various areas. The company plans to strengthen its presence in chronic and rare diseases by accelerating research and development efforts. This includes building a resilient innovation pipeline through an open-ended innovation ecosystem. In addition, management is focusing on core therapeutic areas while promoting cost reduction and efficiency improvement. This suggests that the company aims to optimize its R&D system and intensify support for innovative products. Furthermore, management is investing in core technology platforms and exploring new areas such as radiopharmaceuticals and small nucleic acids. Overall, the company's strategy appears to be centered around driving innovation, expanding its presence in key therapeutic areas, and optimizing its operations to achieve greater efficiency and effectiveness. The company's financial performance is reflected in its dividend and share buyback policies. In terms of dividends, the proposed final dividend for 2025 is RMB 0.39 per share, a slight increase from the previous year's RMB 0.32 per share. This indicates that the company has a history of paying out dividends to its shareholders. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it has repurchased 30,875,252 shares, but has not yet canceled them. This suggests that the company is committed to returning value to its shareholders through both dividend payments and strategic share purchases. There are concerns about inventory buildup and supply chain disruption that have been raised. On page 11 of a financial statement, potential issues with inventory or accounts payable were noted, which could lead to impairment losses being recognized in the profit or loss statement. A specific example of this concern is seen in the sales data for two pharmaceutical products, trastuzumab injection, and rituximab injection. The data shows that while there was an 83% increase in inventory levels for trastuzumab, there was only a 9% increase in sales volume. Conversely, rituximab saw a 49% decrease in sales volume, but still experienced a 9% increase in inventory. These discrepancies suggest that there may be issues with managing inventory and supply chains, which could have significant financial implications if not addressed. That concludes the financial summary for Shanghai Fosun Pharmaceutical Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.